The Fed held rates steady as expected, but Kevin Warsh's first meeting as Federal Reserve Chair has sparked fresh debate over the path for interest rates. I'm joined now by John Hilsenrath, Senior StoneX Advisor and Fed Whisperer, to break this down. Thank you for joining me, John.
Thanks so much for having me.
So, John, the Fed left rates at 3.5 to 3.75%. What are the main takeaways from this decision other than the hold?
Well, there's two main takeaways. The first one, and I think the most important, is that the new Fed chairman, Kevin Warsh, really planted his flag in the ground on achieving what the Fed calls price stability. They define that as meeting a 2% inflation target. And of course, since COVID, inflation hasn't been at that target for more than 5 years now. People didn't really know if the new chair was going to come in as a hawk who is determined to bring inflation down, or a dove who's not so worried about inflation. And what we saw were signs of hawkishness, which could mean higher interest rates to get inflation back down to that 2% target. I think that was the market's big message. And then the other thing I think, which we all expected, and which the new Fed chair signaled was coming, was that they're just giving less guidance about where they think rates are going. The new chair, Kevin Warsh, thinks that the Fed holds the market's hands too much and ties itself into these rate projections that it makes, which become commitments. So he just doesn't want to be as bound to these what he calls forward guidance, and he followed through with some of that.
So, yeah, I mean, as you mentioned, Warsh's first meeting, and we did learn those things about his style. Was there anything else about his style that you noted which could mean that a Fed under Warsh would differ from a Fed under Powell?
Well, one of the other things that was notable was that he created a whole bunch of task forces, 5 different task forces, to examine different issues relating to how the central bank operates. One of them is a task force on how the Fed communicates. One is a task force on how it measures and tracks its progress on inflation. Another on AI. And then so now these are task forces that are going to be meeting. They have a lot of work to do. He says they'll be done with their work by the end of the year, and they'll come out with new strategies, for instance, on communication. And this is important for a couple of reasons. One is it signals that he wants to follow through on what he calls regime change, changing the way the Fed does things, but he wants to do it in a consensus-oriented way. He wants to get buy-in from others at the Fed around him. But it also buys him some time. And we saw him in his press conference saying over and over again, when reporters asked him questions, he said, well, we've got a task force for that. We've got a task force for that. What that means is he doesn't want to jump in and make a lot of dramatic changes at once. And that's probably going to be the case on interest rates too. The market is pricing in rate increases by the end of the year. And if the Fed does raise rates, it probably comes more towards the end of the year. And that's what Catherine Rooney Vera and I have been saying for some time, and not like right away at the next meeting.
Yeah, because that's interesting, because also looking at the dot plot that we saw in the meeting, we saw that 9 of the 18 policymakers were actually forecasting a interest rate hike by the end of the year.
Yeah. Now, this dot plot is really interesting for several reasons. One reason is that in previous meetings, Fed officials, this is before Warsh arrived, had been projecting on net a median of interest rate cuts this year. And now they've taken that away. Of course, the inflation story has changed. So it makes sense that they've gone towards a stance that's either neutral or a hike. It makes sense because of the way inflation has behaved. And that is really the debate inside the Fed over the next few months. Do we raise or do we hold? Now, the other thing that's interesting about this dot plot, this famous Wall Street, this dot plot that's so famous on Wall Street, is that Kevin Warsh himself doesn't like this as a mechanism for telegraphing where rates are going. He didn't submit an interest rate projection himself. As you said, there were 18 projections. Well, there are 19 people in that group, and the one who didn't make a projection was Warsh. So what we saw with the dot plot was the environment around him. There's an even split among officials between those who think they're going to need to raise and those who think they're going to hold. And what I think happens, again, this relates to this idea of buying a little bit of time with these committees. I think they're going to let things play out a little bit for the next few months, see how inflation behaves, and then make a decision towards the end of the year. The war in the Gulf looks like it's ending. Maybe that'll cause some relief on gasoline and oil prices. So maybe they get some breathing room and they don't have to raise rates to hold down inflation. I think they want to see how a lot of this stuff plays out. So we're heading into a really critical period, not necessarily for watching the Fed, but for watching the economy and the inflation data to see how they're going to force the Fed's hand.
Yeah, that's really interesting that you mentioned that, because, yeah, we've got, inflation is above target at the moment, isn't it? Around 4.2% for the CPI. But oil prices are falling and the labour market is holding up. So what do you think the Fed will actually be watching most?
Well, certainly they're going to be watching the inflation data, but they're going to be watching a broad range of inflation data. The Fed traditionally looks at this measure called core inflation, X food and X energy. And, that takes out the oil story. And that's also elevated. That tells us that it's more than just this war in the Gulf. Kevin Warsh doesn't love the core reading. He's looking at others like medians and then there's CPI and PC. I think we're going to have to look at a broad range of indicators to get a sense of where things are going. I'll say one other thing that really jumped out to me about these interest rate projections, and something that I've started writing about, is this idea of a round trip ticket. If you look at the rate projections, what they show is that officials expect to raise rates a little bit this year and then cut them next year. Now, the market, I think, tends to see the Fed as this really inertial institution that when it raises, it keeps raising. And when it cuts, it keeps cutting. And the market sees it as inertial because it tends to be inertial. That usually is the way the Fed reacts. But hey, we have a new Fed chair. And I think you can make an argument for why the Fed might raise rates a little bit now to take some insurance out, to make sure that inflation really does get back on that downward trajectory. And then when they see it happening, when they see it in the real data, then they could take back some of those rate cuts. I think that's a scenario that's now out there that the market needs to internalize. And I know we're going to be talking more about that here at StoneX.
Well, great to hear your insights. Thank you for joining us, John.
Sure. Thank you.
For more videos like this, please do like and subscribe.